Hi there, and welcome to this blog where I'm going to be running through the solution to an example I set in my last PQ magazine article on incomplete records. My name is Gareth. You've got my email address there. I'm a managing director with First Intuition, one of the UK's premier accountancy colleges. My email address is garethjohn@fi.co.uk. I'm also very active on Twitter. So particularly if you're an AAT student, feel free to follow me at AAT Top Tutor. I answer student queries. I post lots of relevant links to similar blogs to this. Now, as I said, I work for First Intuition. We've been very, very pleased over the last few years. We've won a number of awards for what we do with our students. We won Accountancy College of the Year in 2010, 2012 and 2014, 3 times in 5 years, the first college to ever achieve that. I personally won the UK Lecturer of the Year in 2011, and we're also nominated for Study Resource of the Year in 2013, so hopefully we know what we're doing. Hopefully you're in safe hands with this. Well, the example I'm going to be running through is an example of incomplete records technique, which is a very exciting detective process of looking at information that we've got and using it to identify information that we don't have, seeing if we can find some missing figures from clues that we do have. So why don't we put on our tight-fitting suit, put on our deerstalker like Sherlock Holmes, and have a look at this example. So what are we told? Well, we're told that at the 1st of January, so that's the beginning of the year, we had inventory in the storeroom of £10,000 worth of stocks. That's our opening inventory. And trade payables, so amounts owed to our suppliers, of £40,000. That's the liability for credit purchases we must have previously made. So that's information at the beginning of the year. During the year, we're then told that we made sales of £400,000. That's the revenue we've generated from selling to customers. And we achieved a profit margin on that of 25%. So we're being told a little bit there about the cost structure of the business. We've got a profit margin of 25%, and hopefully you're aware that margin means margin on sales, which we'll come to shortly. During the year, we also paid our credit suppliers a total of £290,000, so perhaps we sent cheques to our suppliers for that value. And then at the end of the year, we're told that trade payables were £65,000. That's the remaining liability we still owed our suppliers at the end of the year. We're then also told that at the end of the year, on the 31st of December, there was a fire in the warehouse which destroyed all the units of inventory that we had at that point. Now, can you imagine the inventory that was sitting in the warehouse on the 31st of December, which is the end of the year? That would be the closing inventory. That would be the closing inventory that we had at the end of the year. Now, the big question here, the challenge for Sherlock Holmes, is to help identify the value of the inventory destroyed. What was the value of that closing inventory? For instance, we might need to make an insurance claim, and we need to identify how much stock there was. So as we work through this process, I'm going to show you 2 or 3 of the techniques that are very useful for incomplete records. And I'm going to start by going back to our knowledge of 2 things here: the sales we've achieved and the profit margin that we've earned on that. Now, if I start looking at that, now margin, I always think is short for margin on sales, because the percentage margin would actually be applied to the sales revenue. So margin is margin on sales. If we'd been told about a markup, well, markup is markup on cost. And so you'd actually apply the percentage markup to the cost figure. Now, in terms of how we can show this, different ways you can lay your information out, but if you imagine how a very succinct profit and loss works, you'd have sales less cost of sales would give you your profit. Now, we know in this example that the sales were 400,000, but initially we don't know what the cost of sales is and we don't know what the profit is. There are missing figures that Sherlock Holmes is trying to identify. Well, because we know the margin, we can actually identify what the profit is, because if the margin is 25%, well, it's a margin on sales, so you'd literally multiply the sales figure by that 25%. And if you take 400,000 times 25% or times 0.25 on your calculator, you should get that coming to a profit generated of £100,000. That's 25% of your sales. And we can actually now establish what cost of sales must be. Cost of sales, well, there's two ways to think of this. Either cost of sales is just the difference between your sales revenue and your profit, and the difference between 400,000 and 100,000 is 300,000. That's what's sometimes known as a balancing figure approach, just working out what number must make it balanced. Or the other way to think of it is if your profit margin is 25% of your sales, the costs must be 75% of the sales. And if you multiply 400,000 by 75% or by 0.75, you should get that coming to 300,000 as well. So can you see that with my knowledge of the sales figure and with my knowledge of their cost structure, in this case the profit margin, I've been able to find a couple of missing figures. I've been able to drive cost of sales and I've been able to drive profit. Now that's using a margin on sales. We could have done something fairly similar if it was markup. Markup, though, is short for markup on cost. So it would actually be the cost you'd be multiplying by the percentage. Well, why is the information we've generated useful? Well, I've particularly identified what my cost of sales figure is. Why is that useful? Well, let's think about how cost of sales is made up. Again, this requires a little bit of financial accounting knowledge. Well, cost of sales is calculated by taking opening inventory at the beginning of the period, add the new purchases made during the period, and then deduct any closing inventory at the end of the period. That's how we'd work out cost of sales. Now, we actually already know cost of sales. We've just worked out, using our margin, that cost of sales must be £300,000. And I know that's going to be made up of these three elements. It'll be made up of opening inventory plus purchases less closing inventory. And in fact, from the original example, let's go back, well, we were given the opening inventory. We were given £10,000 on the 1st of January. That's the opening level of inventory, so I know that figure. Again, it's all about using clues of what you do have to drive what you don't have. So if I add on purchases and then deduct closing inventory, that should come back to £300,000. Now, the figure I'm actually interested in finding here is the closing inventory. Remember, there was the fire at the end of the year that destroyed the inventory at that point. That's what I'm trying to identify. So if I can actually work out what purchases is, if I can find one of these missing figures, I might be able to identify what closing inventory is. Now, in terms of identifying what purchases are, well, purchases is relevant to suppliers. You make your purchases from suppliers, and you've actually got various bits of information related to your suppliers here. You've got the opening trade payables balance. That's what we owed suppliers at the beginning of the year, the 40,000. We've got the payments made to suppliers of £290,000, the cheques I perhaps sent to them during the year. And we also know that at the end of the year, we still owed them 65,000. So can you see we've got three numbers here that related to suppliers, and they might help me establish what the purchases were. Now, the way I would go about doing this calculation is I'd use a control account. And the control account I'm interested in is the purchases ledger control account, because the purchases ledger control account keeps track of what I owe my suppliers. And the trick with these control accounts is fill in the figures you do know, and that should help you derive a figure that you don't know. So what did we know? Well, we knew what the opening balance was at the 1st of January. Now, the opening balance on the purchases ledger control account will be on the credit side. Remember, purchases ledger control account is a liability, and with our double entry principles, we show liabilities with credits. So we had the opening balance, which we were told was £40,000 at the beginning of the year on the 1st of January. We paid them cash during the year of £290,000. Now, how will that affect the control account? Well, that'll actually be a debit entry, because if you pay cash to your suppliers, it actually reduces what you owe them. And to reduce the liability, we have to debit it. So we would debit the control account with the 290,000. You don't have to imagine the other side of that double entry as a credit to your cash or your bank account. You'll be crediting bank because you're paying money out, aren't you? And then at the end of the period, we had a remaining outstanding balance of 65,000. Now remember, closing balances are always shown on the opposite side to the opening balance, where the opening balance was a credit to show the opening liability. The closing balance will be on the debit side, because that will then be carried down as a credit at the beginning of the following year. And so we've got a closing balance of £65,000. So you can see I'm putting in the figures I do know, and we can then balance off the T account to identify the figure we don't know. And the figure that we don't know is the purchases figure. How much did I actually buy from my credit suppliers? Now, purchases would be a credit on the control account, because if you make credit purchases, it increases the liability, increases what you owe those suppliers. The other side of that double entry, you can hopefully imagine, is a debit to your purchases account to show the expense you've suffered. But I've now got a big question mark on what that purchases figure is. But again, we can work it out using a balancing figure approach. What does that need to be to balance up the T account? Well, if you look at the two sides of the T account, you can see the debit side is clearly bigger. So in the usual way, add up the two sides. Well, on the debit side, I've got 290,000 plus 65,000. That's a total of 355,000. You can see at the moment the credit side is only 40,000, so the debits are far bigger. So put that higher total on both sides, 355,000, and then work out what is the balancing figure to make the T account balance. I always think of the T account like a set of scales, and the set of scales has to balance. So what do I need to put on the credit side? Well, to get up to 355,000, if you deduct the 40,000 that's already there for the opening balance, I think my purchases for the period must be £315,000 to make my scales balance. So can you see, yet again, I've used some clues, I've used information that I do have to derive a figure I was missing. And in fact, that purchases figure, that now can go into our calculation for cost of sales, because we now know we're going to be adding the purchases figure of 315,000. And if I've only got one missing figure, I should be able to work that out. Because what we're saying in the cost of sales calculation is the opening inventory of 10,000 plus the purchases of 315,000 less whatever the closing inventory was that was destroyed in the fire. That should equal £300,000. So how much should that question mark be? What is the closing inventory? Well, if you just take the 10,000 of opening inventory and add the purchases figure of 315,000, that gives me 325,000. Now, if that equals 325,000, what would you have to deduct to get back to just 300,000? Well, I think I'd need to deduct £25,000 to make that cost of sales calculation work. And if I just do a double check, if you now take 10,000 of opening plus 315,000 of purchases less the 25,000 of closing, that does give me 300,000. So I think we have now successfully helped Sherlock Holmes. We've identified the value of the closing inventory that must have been destroyed in the fire. I can now fill in my insurance claim and get the money that I deserve. But can you see this process? We've taken a lot of clues that we were given in the scenario, and we've used our knowledge, firstly, of cost structures, the margin, then our knowledge of the way cost of sales is calculated, and then our knowledge of how control accounts work. We've taken all that accounting knowledge and used it to help us identify that crucial missing figure. Well, I hope that's been useful. I hope that's given you a bit of an insight as to how we can use incomplete records. Thank you for your attention, and hopefully I'll see you next time.